this is John Persinos, Editorial Director of Investing Daily. To view our full range of publications, visit our website at investingdaily.com.
We've enjoyed a stock market rally in recent months, with the S&P 500 and NASDAQ exiting the bear market and entering a new bull run. The S&P 500 hovers above its 50 and 200-day moving averages, and the New York Stock Exchange Advanced Decline line has been rising, indicating greater market breadth. The CBOE Volatility Index, the VIX, has been falling and hovers well below the threshold of 20, which indicates less fear and stress in the market. The Federal Reserve has paused its interest rate tightening cycle, and inflation is falling. The economy is cooling, but it just might execute a soft landing after all.
So, as an investor, what's not to like? Well, I want to take a step back from the daily market action to focus on an uncomfortable question. Will millions of seniors one day find themselves destitute and reduced to eating cat food? Let me put it this way. America faces a full-blown retirement crisis. The following chart paints the grim picture. Take a look. A recent Federal Reserve report shows that 38% of people aged 18 to 29 have no retirement savings, along with 27% of people aged between 30 and 44. As retirement gets closer, 17% of those aged between 45 and 59 have a complete lack of retirement savings. For those aged 60 and over, 12% have no financial cushion. These unprepared folks will need Social Security the most, and it probably won't be enough. In fact, the social safety net could get even smaller. Politicians in Washington are talking about cuts to social programs, especially to Social Security, as a way to close the massive federal budget deficit caused by the 2017 tax cuts. Meanwhile, as the chart shows, the Social Security Trust Fund is running dry. Take a look. Under current law, the early retirement age of 62 is when you can begin collecting Social Security benefits. However, I strongly advise you to wait for full retirement age if possible. If you start your retirement benefits at age 62, your monthly benefit amount is reduced by about 30%. Your full retirement age is determined by the Social Security Administration based on when you were born. For example, if your year of birth is 1943 through 1954, your full retirement age is 66. Experts estimate that benefits drop roughly 7% across the board for each year that the full retirement age is increased. Current proposals for raising the age brackets, well, they're all over the map. Another proposal under discussion is to terminate or drastically reduce cost of living adjustments.
Want to lay the foundations for a secure retirement? Well, I suggest you follow the wealth-building advice of the experts at Investing Daily. And as we help you build a nest egg, follow this checklist.
Number 1, set a retirement date. It's important to have a specific date in mind for when you plan to retire. Make an assessment of your future spending needs. Number 2, create a withdrawal plan. It's usually best to let your wealth compound tax-free for as long as possible. The greater variety of accounts you have, the more opportunities to diversify your tax savings. As a general rule, you should withdraw cash from taxable accounts first. Later on, focus on tax-deferred accounts such as traditional individual retirement accounts, IRAs, and annuities.
For retirement withdrawals, consider the 4% rule. Take a look at this chart. If you follow this widely used guideline, you'll withdraw 4% of your investment account balance in your first year of retirement. Each year thereafter, you'll increase the amount to keep pace with inflation. If you follow the 4% rule and begin retirement with a nest egg of, say, $500,000, you would withdraw $20,000 during the first year of retirement. If there's 2.5% inflation, you would withdraw $20,500 the following year, and so on. The 4% rule is popular and effective because it's a simple, reliable, and steady way to generate income during retirement.
Number 3, shield inheritance. If you don't take measures ahead of time, Uncle Sam will take a huge bite out of your inheritance via the capital gains tax. One of the few ways to sidestep the substantial capital gains tax is to make a gift of property to a charitable organization. When you do so, you may take a deduction based on the full fair market value of the property rather than just its cost. And number 4, don't underweight stocks and overweight bonds.
What portfolio allocations make sense right now? Well, under current conditions, we recommend 30% bonds, 40% stocks, 15% hedges, and 15% cash. Those are the allocations recommended by our flagship publication, Personal Finance. You should feel free to tweak those percentages according to your risk tolerance and stage of life.
Investors should get more conservative as they get older, mainly because they have fewer working years in front of them. If your portfolio takes a turn for the worse when you're in your 40s, you still have plenty of time to bounce back. However, if your investments take a nosedive when you're 65, well, you're in a far worse predicament. That's why, as you get older, you should increase your portfolio's bond weighting.
That said, it's a common mistake to get too conservative. Keep in mind, bond prices fall as interest rates rise. In a rising interest rate environment, a large allocation to bonds may result in significant capital loss.
Our team of investment experts will help you make the right investment moves to ensure that you have a comfortable retirement. Questions about retirement investing? Drop me a line. I'm easy to reach. Just send an email to mailbag@investingdaily.com. In the meantime, thanks for watching. Stay safe and stay invested.